Yeah, I'm good to go.
Good morning, ladies and gentlemen. Warm welcome to all our participants on behalf of Ceylon Chamber of Commerce. As you know, sweeping amendments have been proposed to the London Act, and the bill to make amendments have already been published by Government Gazette. So there have been far-reaching changes, as you would have seen in the press, and very many discussions that have been taking place in and around the last week. Substantial changes have been made to personal income tax in terms of the rates, in terms of income exempt and now liable. Corporate rates have been increased significantly. So there have been a substantial change that have been made to the tax system. So whilst one can argue for and against the proposals, the policy, the Ceylon Chamber thought it's optimum that we bring to light these changes that have been made and proposed. And we have with us today three eminent people who are joining the session. One is Suresh Perera, Principal KPMG, who needs no introduction to all of you. Suresh is Principal of KPMG and practices law and tax. So Suresh will talk to you about personal tax changes that have been brought about. Then we have Suleiman Ista from Ernst & Young, who will talk to you about the corporate tax changes. Suleiman is also a partner of Ernst & Tax and needs no introduction in his capacity as a partner. Then we have from the industry, we thought we invite someone who can share industry experiences, industry's perspectives into discussion. So we invited Mr. Revanji, Head of Tax of Jonkis Group, which is a diverse group of companies and diverse issues. We thought we invite her. Unfortunately, we couldn't get into the government. I invited Tanuja Perera to join the session, but she had to be in Parliament today to the Public Accounts Committee, so she's unable to be there. Then we have Shiran Fernando, our own economic analyst. So if on economic point of view, if there are any issues, Shiran not on the panel and the discussion, but if there are any issues that come, Shiran can always answer. So Ceylon Chamber, we have seen the articles with the paper that came. We have acknowledged the changes, but at the same time, we have asked for transparency and accountability of the government expenditure, which all are talking about. So in this meeting, we will not be focusing on policy because policy is not within us to discuss. So we will be more discussing about the changes and any clarifications you want to seek. We can do the question and answer session. So with those introductory remarks, by thanking everyone for being here, thanking all my panelists at the Ceylon Chamber for organizing this session. We have already about close to 500 participants joining us. May I hand it over to Suresh Perera to start his presentation. Over to you, Suresh.
Thank you, Dhaminda. Good morning, everybody. Hope you can hear me.
Can hear.
Right. Okay. So I have a set of slides, so I will share it first, and then we'll move. Are we okay? Can my slides? Are my live slides visible?
Can see.
Is it in the presentation mode? Okay. Right. Okay. Great. Good morning, everybody. Sorry about that small delay. Right. So I'm going to talk about personal tax. Suleiman will be speaking about the corporate tax. So within 15 minutes, let me see what I can give you all here. Now, I think the first message that I want to tell in relation to the personal taxes is, as Dhaminda pointed out, there's much discussion with regard to the rates changes or the increase of the personal tax rates. Now, before analyzing this increase, I think we need to see exactly what happened and where we are when you're talking about the increase, what is the comparison, what is the benchmark that we should be using, right? So because most of us are looking at the 18% that we have now going up to 36%, but actually before 2019, it used to be 24%. And then there was a dip to 18, and then only it's going up to 36. So actually the comparison should be not with the current rates, but with the rates or the system that prevailed prior to 2020 is what we should be looking at. Now, when we are doing that thing, okay, let's go out of Sri Lanka and have a look at the rates outside Sri Lanka as well. So you can see the global average highest rate is 31, and what we have proposed is 36. It is high though, but at the same time, when you compare it with some of the other countries, you can see the countries that I've shown here, the Australia, India, Canada, United Kingdom, Singapore. What do we see basically? Most of the European countries and even Australia basically is going in, the rates are like in 40s, no, 42, 45, 45, and Singapore, okay, is a low country where we have about 22. So it is in that context that we need to look at our rate also. I'm sure there is a how do I say, response that will come saying that, okay, in those countries, though the taxes are collected, though the tax rates are high, there's benefit from the government to the citizens. And in Sri Lanka, whether there is that benefit, whether there is that, how do I say, the payback is what people are asking. Right. So a justified comment though, but let's look at in a nutshell what's happening here. Right. So I have, throughout my presentation, I have these three colors. Prior to 2020 in one color, and what happened the period after 2020 in orange or yellow, and then red, what is to come, what has been proposed. Now, before going further, I think this is a bill stage. Actually, after the cabinet approval, this has been published in the Gazette, and it should be there for 14 days, and thereafter on it could be placed in the order paper of the Parliament according to the procedure. So once it is placed in the order paper of the Parliament, for within 7 days, if anyone wants to go to court, can go to court, and thereafter only the proper legislative process will commence. So in between, still that is the final stage is for the Speaker to sign off, as you all know. Period from now to that final act, there could be many changes that could that we may witness with regard to these numbers, the changes that have been proposed. Also, this is not something static, right? So that's what we have to keep in mind, because as I understand now, right now, certain provisions are under revision or basically under discussion with regard to comments that are being made. Right. So, sorry, I did not comment it. So personal tax relief used to be 5 lakhs, and for individuals, there was employment relief of 7, also altogether 1.2 million for the people in the corporate sector. And that was increased to 3 million in the historical change that happened in the beginning of 2020, right? So now it is that is being reduced to 1.2 million in the bill. And the chances are sometimes that might also change. So let's keep our fingers crossed to see. And the expenditure relief, there were 5 types of expenditure that were recognized, and 1.2 million relief was given, and that has been taken out. And the highest rate, what we looked at earlier also, 24% came down to 18. Now it is proposed to take it up to 36. And the slabs prior to 2020 used to be 6 lakh slabs, and it went up to 3 million. And 3 million, and then that is being reduced to 5 lakhs. So we have to wait and see whether that will be the thing. So changes at a glance. Yes, tax rates are going to be from 6 to 36. I think all of us are now familiar with this rate structure. And as I mentioned, the slabs are going to be 5 lakhs, and the personal relief is coming down to 1.2 million. So what does that 1.2 million signify? That means for a month, any person who has more than 1 lakh is exposed to tax. If you are below 1 lakh, you are not exposed to tax. Earlier, it used to be 250,000. That means 2.5 lakhs. If the income was above 2.5 lakhs, there was a tax exposure, and below, it was not. So the people who are between those 2 points, 1 lakh and 2.5, are the ones who are coming to the income tax net now again there, right? And expenditure relief, as I mentioned, has been taken out, but what we have to keep in mind is rent relief for 25%, and the solar relief is continuing. That is a 6 lakhs reduction for a year. And APIT, AIT and WHT is being made mandatory, which shows they are as an optional kind of thing during after the change that we witnessed. And the most important thing, I think, for individuals will be how to calculate the income tax. Now, according to the message coming from the Inland Revenue Department, based on this, we have to do 2 calculations. For first 6 months, 1 calculation, and the second 6 months, the second calculation. And I'll go a little bit faster in relation to this. I'm sure most of us are now familiar with this stuff here. 6 to 18% revised to 6 to 36. I mentioned that thing. And right, so in the purple table, you can see personal relief, what used to be 3 million, and first 3 million taxable income was at 6%, 12%, and 18%. And how it is being proposed to change is in the green table. So 6 to 36, and you can see the slabs are changing every 5 lakhs, and the personal relief is 1.2 million. So this is for a year, what we have to keep in mind. But okay. So removal of the expenditure 1.2 million, some of us found it very useful, but at the same time, there were certain things we felt that were unnecessary. For instance, basically expenditure in the purchase of shares, treasury bonds, and treasury bills. In my personal opinion, that's an unnecessary deduction. So here what we see is all 5 types are being scrapped, not a selection basis. Now, here my personal opinion is, I think out of these 5, maybe the interest paid on the housing loans deduction should be retained. Maybe other 4 can go out. It should not be a case of, basically throwing the baby with the basin kind of a story here. And so the important thing is this year, 22-23, how do we do the tax calculation? So as I mentioned earlier, first 6 months, there's going to be a separate calculation, and the second 6 months, a different calculation. So for the first 6 months, there is the personal relief 3 million is prorated up to 1.5 million. So what we keep in mind is with regard to the first 6 months, the period, there's not going to be a change as such. It's only things are getting prorated. 3 million into 1.5 million, the expenditure relief, which was there for 1.2 million for a 12-month, is being prorated 6 lakhs for the 6 months period. So it's not basically the release being slashed, it's release being prorated, taking into consideration the number of months that are there for that period, right? So the rates remain same also for the first 6 month period. The change is coming from the second 6 months, and that's where basically you can see the rates taking place here. And so let's quickly look at the situation. The moment this budget, these new proposals came, department came up with a press notice to provide clarity. So in a nutshell, what the department is saying is, don't get excited. Just have a look at, just stick with the current rules that they have issued, or current rules that are there in the law, and follow those rules until the amendment is passed, right? So that's what we have to keep in mind. And advance payment of income tax, yes, what we used to call APIT or the payee has been made mandatory. That means the companies, the employers, going forward, when you say going forward, from the date this becomes law, that means passed by the parliament, the companies will have to start deducting the taxes from employment income, just like good old days, what we used to call the payee taxes. So it's basically a different name that we have, but still we are going back to the same scenario. Okay, there's another inclusion that is there more. I would say it's a clarity. So what is the clarity here? if any payment is being contributed to a pension fund or kind of a fund in relation to retirement payments, at the point of contribution, if it is taxed, at the time of retirement, when the claim is being disbursed, that amount will not be subject to taxes again. That is to provide to ensure there is no double taxation. Right, now let's go to analyze in detail a little bit with regard to the controversy that we witnessed with regard to these changes. Right now, as we all know, the general inflation of the country is around 70%, and the food inflation is higher than that, 80%, 85% or around something there. And again, I keep using this Adam Smith's quote, the principle, the canon of equity, to say that even on a normal day, the general principle with regard to imposing a tax policy is to ensure that broader shoulders should bear greater burden. And today, it's more relevant than any other time because of the crisis the Sri Lanka is facing. And I think there is a justification for people who are earning high income to contribute to this crisis, to help the government at this juncture. So let's see what's happening here now, right? So what I've done here is I've included the salary, monthly salary on left-hand side corner column, and you can see tax liability that used to be there before 2020. That's the green column. And then from there, you can see the honeymoon period or whatever from 2020 when the taxes were slashed, cut down, the prevailing tax liability, the tax liability that we witnessed, right? So you can see, let's see, when a person had a 3 lakhs income, 3 lakhs income earning person used to pay 20,000 before 2020. And that 20,000 came down drastically to just 3,000. So now we are being called upon to pay, if you are earning 3 lakhs, you can see 35,000 is the payment that is being expected. So now what we are doing is we are basically comparing the yellow column with the red column. We are saying earlier we paid only 3,000 rupees. Now it's going to 35,000. So there's a 1,000% increase in tax payment. So to my mind, that's not the correct way to look at it. It's basically we need to go back and go to the yellow, the green column and check and see what did we used to pay at that time. Yes, it was 20,000. That 20,000 is going up to 35,000. So what is the actual increase? The actual increase, I would say, is there 75% is the actual increase. So even compared to prior to 2020, yes, there is an increase, but that increase we have to understand correctly, not the blue column increase that we should be comparing with, because as I said, that yellow column represents a honeymoon period, abnormal period that we had, right? So in this context, what do I have to say? You can see, yes, when you look at the purple column, yes, taxes are going up almost. So the variation you can see from roughly around 50-75%. That's the all across the salary scales, various salary scales. That's where the increase is. Now, when you go back again, you can see general inflation is 70%, food inflation is 84%. So taxes are increasing by, let's say, maybe 70-75%. That's the area. Again, I'm showing you all these numbers divided into the 3 periods. So in this slide, I have plotted the green, what do you call the green line, what used to be before 2020. So that's the middle path, and then the taxes came down, and that's the orange line. And what is being proposed in the bill is the red line. So you can see how the tax liabilities have changed or basically proposed to be increased. Now, again, this red line, the chances are certain things might change. Let's keep our fingers crossed to see, just to give you an idea. So you can see a person who had 5 lakhs used to pay 66,000, and that came down to 15,000. And now that person will have to pay, according to this bill, over 1 lakh if the person's income is 5 lakhs, right? Right now, there's something interesting that I'm showing in here. Now, when the salary is increasing, how is the percentage increase of the tax payment? Now, the data that I have taken here is the comparison of the orange column with the red column. That is what all of us are talking about, right? Without comparing with the green column. Now, when you plot that, you can see the people compared to the current system, people who are earning low income. Let me see the 3 lakhs, 5 lakhs, 4 lakhs that taken as the low part, and then up to 1.5 million. The higher the salary, lower the percentage increase compared to the current position is what we see here. So this is where sometimes the question mark that will come. Is that a correct policy to collect more taxes from the low income earning group? So when I say low income, I'm talking about people who are getting 3 lakhs up to 5 lakhs kind of a thing, right? So now everyone is faced with the general inflation, everyone is faced with the food inflation. So now the tax increase also, the high percentage of increases compared to the currency too is coming from the low earning income. More higher the income, lower the percentage increase is what we can analyze in this scenario. Right. So my time is running up, so I'll go a little bit fast. So there are certain other changes also with regard to capital gains. Capital gains and how do you say, 40% that is applicable to individuals remain same, but the 14% applicable to gems and jewelry and the renewable energy sources applicable to individuals, that 14% is being removed. And then who should file an income tax return? I think that will also now see a small change. Right now, everyone has to file an income tax return. Going forward, if you have only employment income, where it will be subject to mandatory APIT, will not have to file an income tax return. In addition to that, since the dividend is a final withholding payment, so if you have only salary income and the dividend income, then again, you will not have to file an income tax return. But the situation changes if you have interest income in addition. If you have an interest income, then there will be a requirement to file an income tax return and make a payment also in relation to interest income, because from banks, when the interest is being paid, 5% will be withheld, but you have to pay the balance 31% according to your tax, what you call this, the slab, progressive slabs that are applicable to you and the rates that are applicable to you, right? Right, with regard to terminal benefits, the things are not changing, but where compensation or loss of profit and provident fund, where it's being paid according to a scheme which is not approved by the CGIAR, or retirement non-cash benefits, standard IT rates will be applicable. That is the rule. But what's going to happen is since the standard IT rates are going to change, therefore there will be a change, not a specific change directly targeted there, right? So yes, I think these things are now common knowledge. Advance income tax, yes, basically with regard to the investment return, mandatory, the person who is making the payment should deduct, and depending on the nature of the payments, there will be certain withholding taxes, or what you call the AIT.
Shreena, what happened? We lost Suresh, right?
I think we lost, yeah. He's gone offline.
Yeah. Can we start with the corporate thing, then you can?
Yeah, we can take Suresh after that.
Suleiman, you're there?
Yes, sir.
Yeah, you'll start. Yeah, we can take Suresh back later.
Sure. Good morning, ladies and gentlemen. Can my screen be seen, Shira?
Yeah, all good.
All right. Right. So thank you to the Chamber of Commerce for giving me this opportunity to present the corporate changes coming through the Inland Revenue Amendment Bill that was gazetted last week. So these changes, as you know, and I think Suresh did brief on it, this is not law yet, right? This is a bill that is a proposed change to the existing Inland Revenue Act, which will come into effect only after the law is passed in Parliament and the Speaker certifies it. So it is important now that we assess what the implications of this, and that's why I think all of us are going through this through the chambers and various other bodies, that we as various stakeholders affected by this look at the implications of it. And whilst this is solely or primarily to enhance the income of the government, we need to also perhaps look at the other impacts that it will cause, and then that feedback, there should be a mechanism where that feedback is sent back, and there is still opportunity where there is anything that is detrimental overall to the economy can be changed through the committee stage. And that process, I think, will happen in the next 2 to 3 weeks before this law is passed. So in this bill, there are, unlike normal general other bills where there is one effective date where all provisions or most provisions do start, this has several timelines when several different sections would come into effect, right? So that's where it becomes a bit tricky. And that's where I think from a business point of view, from a practitioner's point of view, and even the government's point of view, this needs to be taken into account when decisions are being made. So the first timeline that this comes with is the October 1st, 2022. That is the beginning of this month, which has already passed. So there are several amendments that are coming into effect from October 1st of this month, and those are primarily the rate changes, right? So once this gets passed, let's assume it gets passed in November, then this provision coming into effect on October 1st is going to have retrospective effect. Then there's another set of provisions that are coming into effect from the passing of the law, right? When the date it gets passed and certified by the Speaker, it becomes law, certain other provisions are going to come into effect. So those won't come into effect from October 1st. So those are primarily the withholding sections, right? Where you're supposed to withhold upon a payment like interest or dividend or PAY or APIT on salary. Those are going to come into effect from the passing of the law. Then there are some that are going to come into effect from April 1st, 2023, next year, starting of the next year of assessment. Certain concessions, holidays that have been given, they're giving the full year to enjoy it, and it will come into effect only from April. Then there are some others that are going right back to 2018. So those also you need to watch out for, because those returns have already been filed. April 1st, 2018, we have April 1st, 2021 and 2022 as well. Right? So it is complex in that nature as to when what would really apply. So what I've done is for corporate, we've analyzed this in terms of certain industries that are going to get affected, and I'll quickly run through them and then go into the impact on deductions. So as you know, exporters, one of our biggest contributors of foreign currency to the economy as well as employment, and indirect exporters are significantly impacted. And these impacts we are seeing it only upon this bill. We didn't see it earlier in the cabinet releases or the mini budget that came through. So the 14% rate that was applicable to export is going to go up to 30% with effect from October 1st, right? So when you say October 1st, so this year of assessment, that is 22-23, is going to have 2 periods. The first 6 months would be at 14%, and the balance 6 months will be at 30%, right? So in this context, most exporters would have entered into BOI agreements, at least a good number. So if there are any preferential rates in the BOI agreements, based on those clauses of the BOI agreements, they may supersede. So there is a possibility that you can rely on a lower rate in the event that the 30% does come, and your VOI agreement is still in force. Similarly, supply of goods to exporters, that's also another significant area with a lot of outsourcing that goes on, and certain goods are actually supplied to exporters. Those were also 14%. That is also proposed to go up to 30% with effect from October 1st. There again, BOI agreements having lower rates should be looked at carefully to see if those lower rates can be taken. Then a provision of services to exporters also had a lower rate of 14%. But here the foreign currency had to be paid by the exporter to the supplier of services. Only in that case, the 14% came in. So suppliers of services also from October 1st are going to go up to 30%, which is more than a doubling of the income tax rate. So in this supply of goods and services, the central bank has in the current context prescribed mandatory conversion rules for exporters, right, for both goods and services. So whilst these rules have changed from time to time, the fact remains that the exporters may not be able to now pay payments in foreign currency to the service providers and those who provide them goods. And the condition for those suppliers to get the 14% is that foreign currency does come in from the exporter. So to manage this situation because of the crisis, there is a special provision in this bill that allows that due to the mandatory conversion, the exporter may not have foreign currency to pay, and hence they are now going to be bring in the condition that if the exporter is prevented from this payment due to the current crisis, the exporter can issue what is called a confirmation of his foreign currency receipts, and that would enable the supplier of goods and services to the exporter to qualify for this 14% in the first 6 months, right? Because the second 6 months will be liable at 30 anyway. So that is a concession given the crisis. So the other major sector that is was benefited in the last reduction of tax rates was manufacturers, who got a special rate of 18%. Also significant in terms of the economy and employment and GDP, would also now go up from 18% to 30% from October 1st. Agriculture, one of the few areas that have been spared in this onslaught of changes. Agro farming, right? So that is at the real primary level where you actually grow. You're the grower of the crop. That had an exemption of 5 years from 2019-20 onwards. So that will go on, that 5 years will go on, and it will expire in 23-24. So that has not been touched. So agro-processing will continue to be exempt. So driving, perhaps incentivizing a drive towards agriculture or primary growing. Similarly, if you are doing beyond just growing, right, that is, you're doing agriculture, you're growing, and then you're doing primary processing or what is called agro-processing, which is defined to basically mean primary processing. There was a deemed exemption because the processed product, when you sell, it had a 14% earlier, right? So, and you used your own sort of agricultural produce for that processing, there was a deemed exemption within. Right? So you take the market value of it at that date, and the exemption was given to you despite you doing agro-processing. So that too will continue in light of the agro-farming exemption continuing. Then what happens to agro-processing? Agro-processing is basically the primary processing of your product, the product that is grown. That was 14%, is moving to 30% from October 1st, right? So that in that context, the exemption in the agro-farming part, which an agro-processor does, would significantly be of help to reduce the effective tax rate of such an agro-processor. Right? So that is something you can evaluate carefully in reducing your effective tax rate, basically. In addition to the deemed exemption, there is another concession given for agro-farming. If you are involved in agro-processing or manufacturing of the produce that you grow, right? If you are manufacturing using the produce you grow, you have the deemed exemption, plus you have an additional relief right, of 25% of the tax payable for 2 years, right, ending in 22-23. That too will continue. So there is a lot of focus in terms of retaining the concessions given for agriculture, at least to a great extent. Another significantly impacted sector is the gem and jewelry sector, which was the only sector that had an exemption at the point of export, right? The exports were exempt. This is proposed to be removed, not from October, but April 1st, right? So they allow the full year to enjoy the exemption. And from April 1st, they go from 0 to a 30%, right? So quite significant in terms of impact. IT, BPO, and services for foreign currency, right? So as you know, IT and enabled services were exempt. Whether it's for foreign currency or whether it's for local currency, there was no distinction. If you fell within the scope in the Gazette of what is called IT and IT-enabled services, you were exempt. Now that exemption is to be removed, but from April 1st, 2023 again, right? So they're allowing them to enjoy the exemption until the end of the year of assessment. And from there, they also will move to from 0 to 30%. However, the services for foreign currency, where the service is utilized outside, that exemption is going to continue as per this bill. So in that context, whether it's IT or services or legal or medical, if the services you provide is supplied and somebody utilizes it outside Sri Lanka, and the money is sent through a bank to Sri Lanka in foreign currency, such services will be exempt, right? So that relief will still be there. Then another significant area, shipping, logistics, warehousing. So a lot of these services that shipping and warehousing did were at 14% under specified undertaking, from entrepreneur trade to front-end services, offshore business, headquarter operations, transshipment, freight forwarding, and so forth were at 14, and all of them are now moving to 30% with effect from October 1st itself. In this sector, there was this 2% of a final withholding for payments made to non-residents for land and sea and air transportation. That will continue, so that 2% final tax upon remittance will apply where those conditions are met. And the exemption on dividends distributed is the only dividend that will be exempt, at least from a resident company outwards, is where you are providing hub services under the Finance Act and having a BOI agreement, right? Such companies, the dividend will be exempt. So here, 3 conditions to meet. You should provide hub services under the Finance Act as defined therein and have a BOI agreement as well. Warehousing, for bonded warehouses, the exemption will cease, be discontinued, and the concession rate for bonded warehouse also will be discontinued with effect from October 1st. So tourism, another significant area. I think we are relying on it significantly to start the recovery process in terms of dollar earnings, has also been hit by the change. So hotels, outbound tour operators will all, so there was all this tourism, there was a definition for tourism that was registered with the tourist board, will also now move from 14% to 30% again from October itself. So here, whether there will be some other area of incentivization like rebates or some preferential rate for electricity or fuel or whatever it is, what they're given to the industry is something we'll have to see. But from a tax point of view, it will also go up to 30%. All sort of tourism related businesses that were enjoying the 14. Education again will go up from 14 to 30 from October 1st. However, government assisted private schools, the exemption will continue. And in this sector, there's a lot of individuals involved. So any service payments other than those employed from lecturers or teachers will have the 5% withholding coming in. Similarly, healthcare was also at 14, will go up to 30 from October 1st. Here, another significant area is payments to doctors that we witnessed 2 years ago. The 5% will come back in where hospitals or any payment made to a doctor would have the 5% coming in, which is not a final tax. Right. So even the small and medium enterprises have unfortunately been brought into this, and it will be liable at 30%. So without any slab, so that is something probably would be suitable to look at, because even if you make a 10,000 profit or a billion profit, you pay 30%. So being a SME, whether there will be some leeway is something that should probably be looked at, because otherwise the commencing of companies to do as startups will probably reduce significantly, and probably they can take the sole proprietorship route. Investments in listed entities. So there was this concession, 3-year concession, where there was a reduced rate of 14% given if you had listed in the stock exchange prior to a particular date. So in that context, they were expecting to have this 3-year concession rate, but that also, as per this bill, has been restricted to October 1st. So that I heard in another conversation we had, that may continue, will be allowed to continue. So, but that will have to come to the committee stage if at all. But as it stands, the 14% will move to 30% from October 1st for those listed entities. However, the exemptions on taxation of gains from the sale of listed shares is going to continue. So that's something that whilst there are significant gains, there can be significant losses as well. So in that context, I suppose they have kept that stagnant without changing it. Significant changes to capital gains also. Capital gains tax by a company. So if you have what is called an investment asset which you dispose of, there used to be a comfortable rate of 10% earlier, which is now moving up to 30%, so which is similar to the corporate rate, right? So it doesn't make a difference whether it's an investment asset or an asset of the business. Still, the 30% now will apply to whatever it is. However, you will have the 30th September cost, so that evaluation probably still have to be done. There you have the 30th September cost if it's an old asset that can be brought in as a concession if it is an investment asset. Then there is also a subtle change to section 46(4), which is a deferment of tax provision, where you do transfers of certain assets within a group, within associates, right? So that has been made a little more stringent with some sort of retrospective effects. So that's something, if you have done any structuring or changing of ownership of assets within a group in the last year or so, that is something which have to be looked at, because there appears to be a retrospective impact on one of the conditions for this deferment. So that's on the capital gains side. So those are basically the rates that affect corporates. I think I have a few minutes more. Quickly run through deductions. Deductions meaning when you compute your taxes, whilst the rate is what we went through now, what are you able to deduct or not deduct as per the law? So a few changes there, not very significant, but we'll just run through it. Any tax levy that is not allowed to be deducted as per respective laws shall not be allowed for deduction. So it appears to be where respective law comes in and that does not allow you to deduct it for income tax, or that specifies that income tax deduction is not allowed, such taxes will be disallowed. So in the case, as an example, if you take SSCL, which I just introduced, that doesn't have such a provision that disallows it for income tax. So then the assumption is that it will be allowed for income tax based on this provision. Then there's a small change to the loans that you take. Therein, it had a clause that the money taken should be utilized during the year. So that utilization during the year has been removed, and if it is utilized in the production of income, then the interest is allowable. So there's a relaxation there. Further, if you make an improvement to a depreciable asset that is fully depreciated for tax, right? There was a lacuna in the law as to how you could take it. So here they are now prescribing, if you have an improvement on a fully depreciable asset, then that improvement cost can now be allocated or deducted over 12 years if it's a building, And if it's not a building, any other asset, you're allowed a 3-year deduction period. Then there is a section for avoidance of doubt. I think capital allowances granted to be limited to the cost of the depreciable asset. That is normally a principal tax, but they are, I think, reiterating it. As well as losses. There is an amendment to losses, and this actually goes back to the beginning 2018 itself, where losses incurred at reduced rates. The principle is that if you incur a loss under a reduced rate, you can't set it off against the profit from a higher rate. Right? That is the way the loss section is drafted. But if that particular, let's say it's tourism, and then they increase it subsequently, then this provision allows you to deduct the lower rate against the higher rate. And it doesn't specify only from that business. It qualifies that loss to be a higher rate loss automatically. So technically you can deduct it from any higher rate profit is the understanding at the moment. Then the significant deduction, I think some companies that are heavy on marketing, there was a double deduction on marketing and communication expenses, which was granted for 3 years, that has been reduced to 2 years. So it will expire in April 1st, 2023. So this year you can still take the double deduction if you qualify for all the conditions. Administration provisions, very quickly, there is a significant change that is impacting the estimates. So as you know, at the beginning of the year of assessment, in the first quarter itself, you have to estimate what the income for that year is going to be and pay 1/4 of that every quarter, right? Now there's this provision that has come that says, gives some guidance as to what that estimate should be, and gives power to the Commissioner General to estimate on your behalf if you have not furnished an estimate, number one, or if your estimate is less than last year's, less than the tax of last year, and if you are not able to justify why it was reduced, right? So that's giving power to the assessor to estimate on your behalf, and you're expected to follow that estimate, right? So the recourse the taxpayer will have to that, if it is arbitrarily done, is not prescribed, but I'm assuming the normal appeal procedure, the administrative review procedure, can be followed if a decision is not agreed with that the Commissioner has put. So that's something to look out for and be careful in your estimate process. The next deadline for your estimate is 15th of November, which you have to do diligently with this in mind. Then time granted to amend a return has been reduced from 30 months to 12 months, as well as the request for administrative review, that is the appeal process, right? So if they don't agree with your return, department can assess you. And currently you have 30 days from the time of receiving that assessment to appeal. Now they are planning to make that 14 working days, right? So a significant reduction, which is going to pose a lot of practical challenges. Another change they brought in is that the expenses to be allowed on a proportionate basis. So where you can't allocate expenses because they are so integrated in different types of businesses, where doing different businesses, then you are allowed to apportion. So this is not going to be too relevant going forward because most businesses are going to be at 30% now. So it's only you have 0, some are at 0, you have 30, and you have 40, right? So may not be relevant to most cases, but if you're having exempt and liable, it may have a, this says now you can apportion it based on proportionate basis. So as well as I think Suresh covered this earlier, now you have to have this year of assessment. They are allowing you prorate, that means a straight line division. You take your full year's income and you're allowed to divide it by 2. And the first 6 months, first half you will apply the old rates, second half you will have the new rates coming in which case whether actually you made more money or more profits in the second half is not relevant because you're allowed this straight line deduction. But the law does say you may do it, so they have given provision to avoid any evasion or anything like that. Will not be allowed. If it's a genuine case, they'll allow a prorating. Right, so I'll just skip through this. I think Suresh covered it. Yes, so that's all from my end. Thank you.
Shiran, can you hear me?
Yes, Ravinder.
Right. So now we get to the panel discussion. Suresh, sorry, you went off earlier. Some technical issue there was. So, Suresh, do you think is it okay if I get into the panel discussion straight away, and whatever clarifications you have missed out, we can clarify at that point? Is that okay, Suresh? Suresh, you're on mute.
Yeah, go ahead. Straight away, you can go to
Yeah,
panel
because
discussion.
we had a short time discussion. So, ladies and gentlemen, that is the presentation, excellent presentation covering both personal tax and income tax made by corporate and personal tax Suresh and Suleiman respectively. So before I start, there are some questions that we have got on the Q&A chat box, plus I also have some questions to ask both Suresh and Suleiman in the interest of our membership participating. But we also have Nisreen Revanji, who has come to join our panel. Good morning to yes, good morning to Nisreen. You're on mute, Nisreen.
Good morning, everyone.
Nisreen, before I get to any questions from both the presenters, will you be able to give the perspective of how, I know it's costing you and your company quite a lot, but if you can give a perspective of or what your reaction is to this tax, given in mind, keep in mind, of course, the situation, the country, the crisis you're going through, all that. What is your perspective? 5 minutes if you can take and give sort of a sum up what your views are on this. Yeah.
All right. Thanks, Dominder, and thank you to the Chamber for inviting me to be part of the panel and two excellent presentations. So, and I think Suresh and Suleiman have covered all the key points. But in terms of like a more corporate view of the bill, I think there are 3 areas that I personally feel that we just need to look at, and I agree in the context of the country situation, the fact that everyone has to pay more, contribute more. I think that's more a policy issue, and I don't have any problems with that. But in terms of how the some of the changes that have been brought into the bill, and let me sort of bucketize it into 3 areas, and some of these were already captured by Suleiman. One is on some of the changes in terms of deductions, some of the changes in terms of administration, and also taxpayer rights. So if I may just touch on the deductions, some of the changes that have been, I think, subtly slipped in, is cause for concern, I would say, because it's attempting to collect more taxes from those who are already paying and deny legitimate deductions that are incurred in the production of income. So let me, for example, take a couple of things. Now, Suleiman, I have a slightly different take on the interest reduction amendment where they say use of money. So in terms of the new law, interest is considered a revenue expense. It's not a capital expense because it's basically what you pay for use of money for a year. So it's revenue. And this is recognized under the law. And when it comes to capital assets, when it has a condition that the asset has to be in use. If the money is used for an asset, the asset has to be in use. Now the utilization provision then assisted when it was construction phase, because the asset was not in use, but the money had been used, and you could therefore claim a deduction of the interest cost. I think that they have actually restricted, because its interest is not a capital expense. It's not something you need to capitalize, because the new law recognizes that it's a revenue expense under Section 12 and allows you a deduction. So I think it's more restricting the deduction than being an enabling provision, as I see it. Then in terms of restriction on set-off of losses against investment capital gains, let's call it capital gains. Now, in an environment where corporates pay 30% tax on everything, why the restriction? And I look at it in a context of the current economic scenario, right? There would be corporates who are struggling, who may have liquidity issues, who may need to sell off investment assets to fund their businesses, right? So on one side, you are saying investment is 30%. On the other side, you may have business losses, you are not allowing that. And if you remember earlier when the capital gains, so-called capital gains was brought to tax, there was this huge conversation about indexation allowances because you're trying to tax gains over a long period of time when you realize it. And that's why the 30th September provision was brought in, the 10% rate was brought in, etc. Now you're suddenly taking it to 30%. Okay, fine. Let's say that is needed, but then why restrict the deduction of losses? So that's something I think it's about these subtle things being introduced to the law that sort of disincentivizes people from being compliant, I would say, because it doesn't allow you legitimate deductions. Then I would also talk about exchange gains and losses. There's a significant amount of uncertainty right now in terms of how exchange gains and losses are being taxed. And in this last year, with the steep depreciation of currency, I think we would have maybe it would have been good to have some clarity in terms of that. And in the context of thin capitalization rules as well, where corporates may have negative reserves, but the thin capitalization does not recognize that, and it disallows you interest costs purely because of a formula being used. So these are a couple of points that I wanted to just bring up. And again, they have brought in a new provision where investment losses or losses on investment assets, they're restricted for 6 years carry forward. Why do we need to restrict it, right? If you had losses, why not allow those losses against gains and allow taxes to be paid on a net amount, considering that it's a very high rate of tax? I also, from a practical perspective, across the bill where withholding tax and APIT and deductions have been discussed, it's effective from the date of the certification of the law. The challenge with that is you are not really giving, though corporates and everyone can put the process in place, it sort of happens instantaneously. You sign the law and it becomes effective. And in terms of administering it, it becomes a challenge. So ideal should have been some timeline after the law is enacted to get the processors, everything together, and then sort of have it sort of falling into place. So something like even 1st of January, 1st of April would have been a good timeline rather than just making it effective immediately. So those are some of the, in terms of things that are practically concerns. And in terms of this subtle build into the law of non-deductions is something that I feel that we need to sort of be concerned about. On the administrative side, and I think Suleiman did address some of these. One is on the estimated tax statements. The fact that a compliant taxpayer who is going to the trouble of estimating their taxes, filing these statements, making payments, you are now questioning them versus putting your effort into actually broad-basing the tax, not in terms of bringing more, just lowering thresholds and bringing people in, but going after the people who are evading tax. Shouldn't that time and effort be actually spent in looking at people who are not paying taxes, who don't have files, who are not filing these estimated tax returns? And we know how the process works. Is it that easy to go and speak to the Inland Revenue and get an estimate agreed? It's a very judgmental call. Now, these are forward-looking numbers we are looking at. So who decides whether, in whose judgment is it going to be reasonable? If you're saying that my profits for this year is going to be lesser than last year, and therefore I'm estimating it to be lower. If the assessor disputes it, you go into this whole cycle of, appeal, whatever that process is, and that's just this additional burden on a compliant taxpayer. Then in terms of the 14-day reduction, right? Considering the fact that Inland Revenue has 30 months in which to raise that assessment, analyze the law, debate, dispute, ask for information, whatever it may be, for the taxpayer to be given 14 days to receive this document, understand it, analyze the law, get consulting if they don't have the expertise, draft the appeals, right, and then submit it, I think is very, very unfair. If the process is to be tightened, then let's reduce the time given to the Inland Revenue to dispute the return. Let's reduce it from 30 months to 18 months, let's say, make it more efficient. So one of the biggest concerns we as corporates have is that when you file a return, until about 30 months, because we all know that, it takes about 30 months for the Inland Revenue to come back with disputing the return, you really do not know whether your return is accepted or not, because it's an interpretation issue. Most provisions can be interpreted two ways. We may interpret it one way. Inland Revenue may be interpreting a different way. There is no right or wrong in that. But considering that there are 30 months in which to do it, and the taxpayer is only given 14 days to then revert on their views of it, I feel it's a very unfair provision and attempt to, I think, I'm not really sure why it was done, but I just feel that it was not in the best interest of the taxpayer. And then I think there are some other provisions, but I'll just touch on one. There is this one section, I think 163, which has been amended to say that there was a provision which allowed the CGIR to take someone to courts if there was taxes in default. Now that provision is there, but it's been extended to cover penalties and interest as well. And it's as per a certificate given by the CGIR that the courts decide. So the taxpayer has no right to question these numbers that the CGIR has given in this statement. And that's a very concerning matter, that there is no process where these numbers can be questioned, because penalties and interest are calculated in certain ways, right? Interest continues on a monthly basis, penalties on a particular timeline, etc. So these are some of the concerning things in the bill. And I don't think it's a right move towards encouraging better compliance, because you're making compliance more difficult and you're making compliance more scarier. And in that sense, that's where I was just finally trying to touch on the taxpayer rights. I think we just need a body which is independent, like an ombudsperson or someone, where taxpayers can go and get a fair hearing. And this is before you go to the Tax Appeals Commission. Yes, you have an appeal process, but remember, when you have to go to Tax Appeals Commission, you have to pay 25% of the taxes, or at least given a guarantee. All those are costs, right? And you have to get legal representation, etc. And I know for us, we are getting this crazy kind of assessments, which is like just numbers. I mean, it's not defendable. So you get these assessments, and then the administrative review is by the same department. Is it independent? I don't think so. Then you have to go to Tax Appeals Commission, which is the next level, but where you have to pay taxes based on the assessment, or 25%. So you need some kind of a independent body in this process before it goes to Tax Appeals Commission, where they review these assessments for reasonability, where it's not just random assessments raised because the time bar is coming up and they want to keep the return alive. And these are very important in the context of these high tax rates. Important in terms of, I'm sure the Inland Revenue having very tight targets in terms of collection of taxes in an environment where penalty and interest provisions are very stringent. So those are a few thoughts, Dominda, that I had in terms of the current environment.
Thank you, Nisreen, for that very elaborate description of the problems faced by the taxpayers, the rights of the taxpayers, and the administrative provision that need to be so thank you very much for that brief presentation, Nisreen. So if I get to the Q&A now, I'll first ask the questions on personal tax. Suresh, quite a lot of them. Question, Suresh, is in terms of terminal benefits. Is there a change? Sorry, to the terminal benefit, tax on terminal benefits? Will it be the same rates with the same exemptions continue? Is the question.
Yeah,
I know you explained that, but there's a question coming here.
Yeah, as I pointed out, basically in the slide, terminal benefits, there is no change, no specific. Specifically, it has not been addressed with regard to a change. But what happens, what you have to keep in mind is, due to the change of the tax rates, now earlier it was 6, 12, and 18. Now the standard tax rates are going up to 36% from 6 to 36. So because of that, in relation to schemes that are not approved by the Commissioner General and the non-cash payments upon termination, those automatically get the impact coming from the new tax rates that are coming. It's not something that the department, the policymakers have targeted and done. It's a natural follow-up because of the change of the tax rates.
So Suresh, if a person, just to make it simple to some other listeners, if a person is retiring after the law comes into effect, we'll say in December, the contribution that he receives from the EPF, which has been exempt from income tax, what you call his terminal benefit, which is part of retirement, will continue to be exempt from income tax.
Correct, yes.
And whatever he paid on the ETF, that interest portion, he will have to tax the same way that was there before.
Correct. Rate. Yes. Though so, nothing, no terminal benefits have been target exemptions or whatever they are.
Then there's also a question regarding provident funds. The provident funds were paying tax at 14%. Sorry?
No, I just want to see whether I can add something to what Nisreen said, because something.
Yes, please. Yeah.
Very important point, because I will forget after that. So the point that Nisreen pointed out with regard to this 14 days thing, it's a 14 days working days, and what the taxpayers must keep in mind is moment the assessment comes, basically now notice of assessment comes, you need to go to your tax consultant fast. So don't even delay 1 or 2 days. That's going to become a big practical issue. Right? And more than that, I think there's another aspect that Nisreen pointed out with regard to this, what do you call the commissions, the assessors, the commissioner, assistant commissioner's power to do the what do you call the set, basically the amount estimate. Now, actually, that provision is there in the law. When this New England Revenue Act came also, I pointed out. Now, what happens is this gives draconian powers to the Commissioner General to come up with a estimate, and there is no provision for us to challenge that estimate. And you have to pay taxes according to that estimate. And if you don't pay taxes according to that estimate, then it's going to become non-compliance. And when you appeal, also what you keep in mind, it's linked to the appeal procedure. Now, you don't have a holdover provision, but you have what is called extension. So now this is going to be a methodology for the Commissioner General to collect taxes, just raise the estimate, any estimate he wants, and it cannot be challenged. So challenge means basically you go for the admin review, but then you don't get a holdover because the holdover provision is not there, and only extension that is there. And that also nowadays you can see it's only a periodical 6 months or whatever that they're giving. So that this is a case of basically actually violating the rights of the taxpayers here in a draconian way. So I think the taxpayers have to realize basically this is something that you need to act now, not later on, because once this becomes law under Article 88(3) of the Constitution, it's too late to do anything. So
yes. So
yeah,
so good point, Suresh. Some of those matters were also discussed in the Chamber Taxation Committee, and we were writing to the Treasury before the bill becomes law to see whether committee stage some amendment can be done. But I was told that some of these amendments have come to recommendation from Parliament, because I don't know they have understood this correctly. They say that there's a delay. Some taxpayers on purpose delay the taxes by by sticking on the legal points, etc. Estimating and paying lesser amounts then with 14 days, or that have come from recommendation from COPA is what I was told. So, but I know I agree with you 100% that it is, and also these assessments come the last moment, right? On 30th of the last day they come, and most often they are posted late, and when you get 14 days have already passed. Yeah, so there's that point is very well taken. Suresh, one more question I want to go to you. There's a question on October deduction. A person who has to pay either APIT or income tax on his own or whatever, would have normally deducted the month of October, the company deducted the tax and pay to the department. Now the law is not available in October. So what happens to October salary when the law is effective on 1st of October? How and when does he pay the October tax is the question that has come to you.
Yeah, so that's, I think there's a good clarification. I think we need to commend the Commissioner General with coming up with that notice, saying that stick to the law that is there right now till it becomes a law. But you keep in mind is the APIT, mandatory APIT kicks in basically from the date of the commencement of the act. So that's a long way. So I don't think we'll have to worry about the October salary. Maybe it will be the November salary, if at all.
Yes. So the October shortfall will have to be paid. If you're filing individual return, you can pay on the quarterly basis. But if you're a person who doesn't have a file, you have to pay. Maybe they have to give some scheme to pay over 3 months or whatever, right? If you have a tax file, you can pay on the file name, file number, I guess. But if you don't have a file, you have to pay it separately. That's a question.
Yeah, no, there's another point there. Again, that is a violation of the vested right. So let's keep our fingers crossed with regard to that issue also.
Yeah. So, so these are the questions that are coming up. So I don't think we can give a clear answer at the moment what you're saying. Right. So the next question, Suleiman, I'll turn to you. There's a question on this concessionary rate given to companies that were quoted in Colombo Stock Exchange. If they are quoted before a particular date, they were given a concessionary rate, but now it has been withdrawn. Can you give the impact of that to those people who already got a quotation based on the concession offered in the law?
Sure. So yeah, there was this concession given, I think about 10 to 15 companies that did take it or did quote during that time. Were anticipating a 3-year reduced rate where you get 14%. So all 14% rates have been sort of increased to 30% from October 1st. So this bunch also falls within that, so they'll get impacted. But what I heard was there is likely to be a committee stage amendment to that. We were discussing yesterday at the Institute with Tanuja. And the intention is to, since it was given earlier, that should be continued. But if at all that is to be continued, it will have to come in through the committee stage. As the law stands, the 14% rate for these companies will be removed and it will be taxed at 30% from October 1st on.
Right. So what you're saying is that those people will get the benefit.
Yes, if the amendment has to come, and the intention apparently is to give the benefit. Yes.
The second.
If I may just
sorry.
come in with one
Please.
point there, I think which I think a lot of people may have missed, that there is a gap in the law when it comes to taxing dividends as well.
I told you the next question was going to be that, so you can. They are going to amend. I was told they are going to amend that section.
Yes, they are going to amend, but until we see the amendment, dividends for corporates are currently, as per the bill, taxable at 30% from the 1st of October until the date of certification of the bill. But I am told that it's going to be changed. And also in terms of pass-through dividends, there'll be clarity in the law, which currently there is a bit of an interpretation issue, but I think it will get resolved hopefully. But something to watch out for.
Yes, when deciding whether to distribute or not. Yes.
Sorry, Suresh, you had something to say.
Yeah, no, just to add to what Nisreen pointed out there, I think the lacuna that we see here, or the defect that we see here, is the only withholding tax. They're trying to make it from the date of the commencement of the act, on the basis basically you can't have withholding being made retrospective. Yeah, but I think what the policymakers miss there is the concept that within Inland Revenue Act, where the transactional taxes that are there, that also cannot be made retrospective. Not only the WHT, the transactional taxes. Now, for instance, capital gains tax, the declaration of dividends, the payment of the dividend tax. Now, all those are basically transactional taxes, not periodical taxes. So, so in my view, basically, the commencement of the date application should be extended not only to the withholding tax, but to transactional taxes like the capital gains tax and the dividend declaration dividend tax also.
So making it retrospective is within the constitution, Suresh, as a legal question.
No, see, according to tax law and according to the constitution in Sri Lanka, retrospective lawmaking is constitutional. But at the same time, when you go to the interpretation ordinance, we can see it cannot take away vested rights. Now, a vested right cannot be retrospective. Now, that is the ground for challenging the bill when it is placed in the order paper of the parliament within 7 days under Article 121 of the Constitution. You can go to courts and take up the position that my vested rights are being violated by this retrospective law. Retrospective laws are permitted, but it cannot touch the vested rights. So this is, yeah.
Thank you, Suresh. Suresh, there is a comment against it. Terminal benefits are not very clear, so you have to explain it a little bit more.
Sorry?
There is a chat box person has said the explanation we gave.
With regard, so correct. So now when terminal benefits are being paid, let's say non-cash benefits and payments which are not approved by, according to a scheme approved by the CGIR, basically go at a standard rate. Standard rate should be applicable. So standard rates prior to this amendment is basically 6, 12, and 18%. but now the standard rates are basically changing. So that's going to be from 6 to 36. So it's going to be 6, 12, 18, 24, 30, and 36. So since the standard rates are changing, when terminal benefits are coming in the form of non-cash benefits and what do you call the sorry, what's the other one? So non-cash benefits and the payments that are not approved by the CGIR schemes things. So since the standard rates are changing, you will find that you will be called upon to pay more taxes in relation to those two categories of terminal benefits compared to the previous period.
So that's, I hope that so it's just clarified that.
Yeah, it is not a thing that has been targeted by the how do I say, the policymakers to say that in relation to terminal benefits also we should collect more taxes. No, it's not the case. It's basically natural follow-up because of the way law is worded and the policy to change the tax rates.
So Suleiman, there is a question to you. I'm combining some of these questions. Ladies and gentlemen, the question that you have sent to me, I'm combining with some are repeated. So I may not answer every single question you have sent. Suleiman, the question is, are all services provided with an individual or a company or a partnership or anyone to someone overseas is exempted so long as dollars come into the country exempt from income tax? Is the question they ask. Irrespective of the dollars are getting converted to rupees under some exchange control regulations, but are they exempt to the question they're asking?
Yeah, so that's the only one of the few exemptions that have been spared, and that will continue to any person. So anyone earning, doing services for receipt in foreign currency through a bank, provided those services are utilized outside Sri Lanka, the exemption will continue under this bill as well. No change to that.
Right. Then there's also so a question on the agriculture, how it works. That is the agriculture. If you have a plantation company and also a manufacturing arm, how the exemption and the concession rate or the normal rate works.
Yeah, so the manufacturing and the agro processing, both of those were lower rates. So manufacturing you had at 18, agro processing was 14. Both those will go to 30% with effect from October 1st, right? But where the advantage is if you are doing your backward integrated and that same company is doing agro farming as well, and that agro farming produce is used for your agro processing and your agro manufacturing, right? In such a case, the market value of that agricultural produce can be computed, and the profits from that can be continued to enjoy the exemption, the 5-year exemption that was given in 2019. So that goes on till 23-24. That exemption. If you are doing only agro farming, then you will be continue to be exempt. You will not pay any tax till 23-24. So it's important to go into these definitions, which are quite sort of complex, and you need to see if you really fall in and make sure that all those conditions are met, whether it be agro farming, agro processing, or manufacturing. And in addition, if you're doing manufacturing or agro processing and you're using your own produce, in addition to the exemption of that produce, you get another 25% reduction if you're utilizing your own agro farming produce in the manufacturing process.
Suresh, a question to you again with regard to allowances or whatever that's deductible from employment income or any other income in arriving at taxable income, 1.2 million given. I think that's what I saw as a question that is coming again to see, is there anything else like housing loan interest, what is left in that to be claimed as deduction?
Yeah, so as I pointed out, basically in relation to individuals, the rent relief has not been touched. 25% rent relief we can use going forward. And also the solar relief of 6 lakhs per year, that is also remaining, that we can continue. But the expense relief of 1.2 million, that's there. So pro rata for the first 6 months, that's fine. But going forward, we are going to lose that because that entire thing is being scrapped. Now, that's what I pointed. There are 5 expenses that are there. Out of that 5 expenses, I think it's justified to retain the interest on housing loans, in taking into consideration the Sri Lanka's national housing policy. Also, my personal view there is to don't scrap all 5, retain the interest on housing loan deduction at least, because it's I think there's a, even when you look at the other countries as well as the history, interest on housing loan has always been a, how do you say, justifiable deduction. At the same time, basically, I think some ridiculous deductions are also permitted in relation to, say, the investment in shares, the treasury bills, and bonds also in there within that 1.2 million. Yes, now that taking out, and other ones I would say are neutral ones. Okay, that is also going out is fine, but not the interest on housing loans, I would say. I would strongly basically advocate to retain that one.
Right. Right. So Suresh, there's one more question to you. I probably have the last question to you and after the Suleiman. I'll ask 2 questions. There are 2 questions you can answer. One is on the withholding tax on service payments. The question is, if the service is provided today, then there is no withholding tax, and the payment is made after the date on which the law is passed, then what happens to those payments subject to withholding tax? 2, whether withholding tax is applicable on treasury bills and treasury bonds, and how those 2 are taxed as an individual or as a company.
Yeah, correct. So basically, with regard to interest, generally there is a 5% deduction that is there at source. But when it comes to treasury bills, it's the government policy that there is no deduction. So you will be getting the full amount into your hand, and on that you will have to pay tax according to your personal tax slab rate. And if you happen to be in the highest bracket, 36%, yes, you will be paying tax on treasury bill interest at 36%. So what is the other one, Dominda? Question that
the other one is when the payment for service payments.
All right. Okay. Now this is a very famous one. Basically, even I think this same question came up when in 1/4 in 2018 also, when the new Inland Revenue Act was being introduced. Whether you have to deduct with when you are receiving a payment for where basically services rendered prior to the period, but the payment is coming now, do you have to deduct or not? That issue came up. So that is a transition issue. I think it's better that the Inland Revenue Department should address it here. But if the Inland Revenue Department is not going to address, my argument is going to be no, it should not be liable for that deduction, because the payment, the service, whatever the activity happened prior to that date.
Right.
Dominda, if I may just come up with a practical issue in terms of APIT and the changes. So yes, the compulsory deduction comes, or mandatory deduction comes in when the law is certified. But remember, the effective date for the changes in the rates is 1st October as the bill stands now. And there are a lot of employees who may have voluntarily opted to go under APIT. So that there is like these 2 populations. And tying that up with the fact that the provision to say that you don't have to file a return if all the taxes have been paid under in terms of deduction. So I suspect that when the law gets passed, Inland Revenue may provide some kind of clarity in terms of how the taxes from October onwards, before the law came into play, should get sort of what should I say, made good through maybe deductions in the future, so that we don't know how that's going to happen. Some may actually prefer voluntarily to have that deduction made so that they don't have to then file a return. Otherwise, you have to open a tax file and pay under self-assessment. So that's also a space that need to be watched out for.
Correct.
Yeah, just to add there also, with regard to the, can I take?
Yeah, sure, go ahead, please.
Yeah, I think doing the other thing that we need to address here with regard to now the withholding taxes are coming, there is a lacuna in this act with regard to the deduction provision. There is no deduction provision. But whereas under the old Inland Revenue Act, when we had the withholding mechanism, the deduction provision also there. From 1/4/2018, when this new one came, okay, the withholding taxes came, but not the deduction provisions. I think inclusion of a deduction provision to this act is crucial to prevent many inconveniences being exposed to many people.
Correct, good point. I don't know which, we have about another 5 minutes, we are all a half an hour behind time. That is okay. I'll take another 5 minutes. Suleiman, the next question is to you. It has come from the Facebook chat box that we are running. On IT services, if a company is providing domestic as well as foreign, what is the tax on that IT company?
Yeah, so IT, for both income tax and VAT, there are two gazettes describing what is covered under IT and enabled services. There is a scope, a definition, and certain conditions that have to be met. If you fall within that, there is an exemption, and that exemption will run till 31st March till April 1st next year. So this whole year will be covered under that exemption, whether you do foreign currency or local, provided you fall within the scope of IT and IT enabled services. Thereafter, the exemption will be removed, and from next year onwards, 23-24 onwards, the exemption for foreign currency, if you're doing IT services which is consumed outside Sri Lanka, for which foreign currency is coming, that will come under the exemption for export of services for foreign currency. That will continue then for 23-24 as well. But the IT and enabled services that are not for foreign currency will be liable at 30% from April 1st onwards next year.
Thank you, Suleiman. So the final question of the session I will pose to Suresh. Again, Suresh, the question is, if an employee is providing services or providing employment to a company outside Sri Lanka, and if it's an employee here, I know what the legal situation is, but the question is that, will the salary be taxable or will be exempt from income tax is a question. Or they can consult you privately also to ask that question.
Yeah, so let me see how this happened earlier,
Yeah.
basically. Though these withholding provisions are there, basically, when a foreign employee was there, legally the foreign employee was basically under obligation to deduct the pay taxes and pay, but in practice it never happened. And administratively, department was happy, they were okay, provided the client, the person in Sri Lanka happens to make the payment quarterly and file the return on its own. As long as no revenue loss to the department, they were okay. So I think that provision, that is how this matter also will get resolved. So I don't see basically foreign companies, the foreign employers registering and deducting a bit here.
Okay, thank you, Suresh, for that. So, ladies and gentlemen, we have come to the end of a very interesting presentation. I know it sounds bad. I mean, we don't take any pleasure in making these presentations because it's bad news for all of us. I mean, all of us will have to pay very high taxes. There are some questions that came on policy, which I didn't take up because this forum is not to address policy. It's more to clarify the issues that are arising from the Act. So just to tell the audience that Shiran is on the chair, also here, the Ceylon Chamber did make submissions to government on the high taxes, but government was unable to accommodate our suggestions because of the current economic situation and the IMF discussion. That's the answer we got from them. But we did make an attempt on behalf of the priority sectors, on behalf of individuals, mostly the middle income individuals who are getting taxed a lot. We made a lot of representation. We met the president, we met the governor, we met the treasury secretary, all of them we did. But the message that came from them was, whilst they also don't like it, but there's no choice in the current situation. That's what people. So leave it at that, because there are some questions that are raised on this line as I asked that question. So with that, I would like to conclude the session. I want to thank the Ceylon Chamber, Shiran, Jayani and her team for organizing this seminar. We had over 500 participants joining us live, which is very good. And I hope you're able to clarify some of the issues, but I know all the issues will not be clarified in a session like this. There will be more and more issues that you all face while the law is getting practiced. And that is why people like Suleiman, Suresh are there to come and help you all. And Nisreen, thank you very much for sharing your insights. Nisreen plays a significant role in the taxation committee Ceylon Chamber. Gives industry perspectives, taxpayer rights, all things she does positively contributes. Nisreen, thank you very much for your participation at today's session. And both Suresh and Suleiman, thank you a lot for participating. And all my participants who participated in the seminar, thank you very much for your participation, and Shiran for organizing this. So with that, I close the session. Thank you very much.